It's a mixed data bag for Italy as August consumer confidence rises but jobs outlook drops. Joining me down the line to discuss is Marco Valli. Now Marco, while the government expects Italy's recession, which is now 8 quarters long, to soften and even reverse, the country's labour market remains hampered, especially for new entrants into the workforce. Higher consumer confidence was reported across most of the country, especially in the industrial northwest, but deteriorated in the poorer southern regions. Now Marco, what is your take on the latest data from Italy?
Yeah, I think it's not surprising that you see that consumer confidence is on the rise because this is a trend which is common across the Eurozone. For instance, in the Eurozone we have 9 consecutive months of improvement in consumer confidence, and Italy is just joining the trend. However, the overall level of confidence in Italy remains well below that of the Eurozone, and that is due to the fact that in Italy there are several domestic factors which are weighing on consumer sentiments, namely poor disposable income prospect due to the very poor labour market situation and the high tax burden. In terms of labour market prospect, obviously you have to consider it is way too early to see signs of improvement, given that we are now seeing signs that the recession may be over, but certainly the recovery is not fast enough to generate new jobs. So this explains why consumer confidence, though rising, remains overall weak and with several differences and splits within the country.
Some analysts say interest rate on bonds also appear to support hopes that the Eurozone's third largest economy may have left the sovereign debt crisis behind. Is recent yield performance really indicative of Italian optimism or more of a comparison to concerns elsewhere, for example in Syria?
You have to consider that current interest rate level in Italy are for the most part the result of the ECB announcement last year when Mr. Draghi announced the ONT program. So this has to be kept very clearly in mind. Then obviously there was also some reform effort by the Monti government which built on this positive momentum created by the ECB intervention. So I would say that at the current level, interest rates in Italy are certainly consistent with debt sustainability, and this is obviously very good news. But certainly we cannot say that the debt crisis is over because Italy still has many challenges in front of it and laying ahead. When it comes to the most recent performance, I think that you have to keep in mind that the level of Italian yields is very much correlated with a broader perspective and broader perception of risk aversion or risk appetite. When the Syria crisis started, there was a wave of risk aversion, and that pushed government bond yields in Italy higher. As tensions in Syria seem to fade a bit, Italian bonds benefited.
Southern Europe's messy debt crisis isn't the only culprit behind the spike in bankruptcies. Italy was already dealing with low growth. Indeed, some experts believe if Italy suffers from a sustained period of deflation and lacklustre real GDP growth in the medium term, a substantial debt restructuring might be the only way to bring debt down to a sustainable level. But how real are these risks?
I don't see major risk of Italy slipping into deflation. In a sense, the ECB is very, very careful on it. For the time being, they are not seeing signs of deflation anywhere across the Eurozone, including, for instance, in Greece, where the drop in GDP and employment has been much more sustained than in Italy. So I don't see this as a compelling threat, although certainly this remains a tail risk. And with respect to the outlook for real GDP, I think that it is clear that even before the crisis, Italy suffered from extremely low potential GDP growth, and the only way out of it is increasing growth potential via structural reforms. So while it is certainly welcome to see recent signs of cyclical improvement, it is also important to stress that Italy has to do more in terms of structural reform to improve growth potential.
And taking everything into consideration which we have discussed, what is your outlook for the euro moving forward, given the ECB's determination to maintain low interest rates?
We think that the euro could strengthen marginally further from current levels, although the room for appreciation is going to be fairly limited, given that the ECB is looking at the euro very carefully because they don't want it to rise too strongly, because that would tighten overall financial conditions in the Eurozone, which is certainly something that the ECB does not want. So in case of excessive euro appreciation, the ECB will be ready to respond either with a rate cut or another LTRO. So further room for appreciation, but limited due to the fact that the ECB remains extremely vigilant against excessive appreciation.
Marco, it has been a pleasure speaking to you. Viewers, for more on the Syria situation and subsequent impact on oil, click back to the website for today's Commodities Corner. But from me, and for now, goodbye.